much, students, and welcome back to one more session of financial management class. In our last class, last few classes we were discussing about what is venture capital, what is the process, stages, advantages, and characteristics of venture capital. So, to do a brief recap, venture capital means a risky capital or that fund which is invested in a new company with high capital cost or high capital investment. So the venture word itself means risk. So it is a funding of startups of new innovative companies which have uh, a considerable amount of gestation period, that is where they develop the product and market it. So in the different stages of the in different stages of that business, the venture capitalists will invest the funds. So today we'll study about the methods of a financing pattern of venture capital. So we can finance with the traditional and the non-traditional methods both. So when you talk about traditional method, it is about own funds, debentures, conventional loans. So that type of a finance wherein uh, the typical old methods are used to raise the funds. On the other hand, we can use hybrid or contemporary methods, which can be conditional loan, income note, quasi equity, and so on. So we have studied about equity in our previous classes. So equity is nothing but the owner's funds. So the own funds, the person who is the owner of the company is going to invest, or it may be the equity shareholders, the people who are interested to become the part owners of the company, they will invest in that business. So equity method of financing is a traditional method wherein about 49% of the total stake or total investment in that venture is financed by an equity shareholders or the owners of the company. So equities in all venture capital funds in India, generally equity provides a large amount of share which doesn't exceed 49% of the total equity capital. So generally their contribution is about 49%. So equity shareholders, you know what are the plus points. They are not secured. As they are the owners, they are not getting the interest. They will get the profits when there are sufficient amount of profits to be declared. They are, you can say, the residual owners of the company, means when after all the expenses, stakes, interest are being paid, then the equity shareholders will get their shares. Okay, so if there are the company is making huge profits, their profit percentage or dividend will be huge. If the company is making only a little bit amount from it just to cover its say interest and other expenses, that time they will not be participating in the profits of the company. So they are the unsecured form of financing where they are the owners of the company. They have the liability, unlimited liability to the extent they have invested in that company. So in venture capital, at least 49% of the total funds are being financed by equity shareholders. Then second type of financing used generally in venture capital is conditional loan. So in a normal loan, or what we call about a conventional loan, traditional method of loan, what we do is that we want an amount. So we raise the loan maybe from a bank or from financial institution, and then we are paying in installments the principal amount and the interest on the said rate on which you have been agreed upon. So you're taking the money, and monthly or in installments at a regular period you're paying back the principal amount and as well as this interest. So this is conventional loan. But here I told you in venture capital we have some kind of fancy new type of hybrid system of loans. Okay, so conditional loans is a method where you take the amount, you raise the amount, but it is repayable in the form of royalty after the venture is becoming profitable. Means when the sales, say I start the company today and it is going under process, sales are not happening, I take a loan. So that loan amount is not payable now. Once the company kickstarts its sales and revenue are generated, then it will pay back the loan in forms of royalty. Now, what is royalty? Royalty means a percentage of profit, and they're not given the rate interest on the amount of loan. They are given as royalty. I mean, the rate of royalty means the share in the profit of the company. So no interest is paid on the loan. They are getting back royalty only when the company is getting sales. But in conventional loan, what happens is, as soon as whether you are making sales or revenue or not, profit is made or not, you have to pay interest. So that is a conventional loan. But here it is a conditional loan, means the loan will be repaid only when, and not in huge amount, in terms of royalty or percentage of profits, only when that firm or company is generating sales and making profit or revenue. Okay, so the rate of royalty, whether it is 5%, 10%, 2%, or 3%, whatever it is, it depends upon what is the gestation period, how much is the cash flow, and risk. Now, what is gestation period? Gestation period means the time where you are making that your idea of business grow. Okay, so you are nurturing it, doing some research and development and making into a product. So if the research and development is taking long time, then the rate of royalty will be more. Okay, if the gestation period is small, royalty will be less, because gestation period is small means you will be making sales very soon. Gestation period is long means the research and development of the product is long. You will make profits later, so royalty will be more. The second factor here is cash flow. Now, cash flow means how much amount of money is needed in that gestation period or whatever it is. So how much inflows and outflows of cash? Regularly you need heavy cash inflows, or you need cash influence at different levels. So constantly if funds are to be pumped in, then the rate of royalty will be more. If the cash flows, inflows is less, outflows is more, the royalty rate will be less. Then risk, higher the risk, higher the royalty, lower the risk, lower the royalty. But in generally, what you term venture capital is, venture means a risky capital. So normally the risk is a bit higher only. Then the third type of financing system used in venture capital is income note. Now, income note is a hybrid, or you can say uh, a combination of a conventional loan and a conditional loan. Now, you know what is the meaning of a hybrid? Hybrid means you're taking two species or two things, combining it so that the end product or the result will be better than the original two. Okay, so we have hybrid flowers and all that. Okay, so we are taking the best of both the things to make a, you can say, so you are taking the good points of two things, combining it in such a way that the end result or the product or the output will be better than the best. Okay, so it's like you're making 2 plus 2 is equals to 22 or 5. Now you may say I am gone crazy, I don't know maths. It's not about maths, it is about making the best out of the product. So say for example you are adding 2 and 2, the output should be more than the normal combination of the two products. So that's why we call it as a hybrid or synergy effect. Okay, so in income notes, what happens is we are taking the good points of conventional loan and conditional loan. Now, what is conventional loan? Normal loan where you take the amount and in installment you are paying the principal and interest. Conditional loan, you take the amount after the sale is happening, after revenues are generated, you will give the royalty. Before that, before revenues are generated, you are not asked to pay back the loan. So now what is income note? Income note is wherein the entrepreneur takes a loan and pays both an interest and royalty on sales. Means the loan amount, interest is not paid immediately, but interest and royalty both are paid after sales have been happening. But here compared to conditional loan, the rate of compared to conventional loan, the rate of interest is much lower, because here you are getting both part of profit and interest also. And you are getting a delayed payment, means you're not paying immediately after the loan is taken next month. No, you're paying it after revenues are being generated in that company. So this is about income notes. Next form of financing used in venture capital is quasi equity. Now quasi equity is a hybrid of equity and debt. I told you what is equity. Equity is owners funds. The owners are getting dividend. They're not secured, they are unsecured. On the other hand, what is debt? Debt is a loan where you are getting timely interest. So quasi equity is a flexible type of debt where it's a loan, but it is availing the advantages of equity. That is flexible repayment options, means you are not going to pay the amount very soon. So equity shareholders are never paid in the lifetime of the company. It is paid only when the company shuts down. So but debt you're going to pay the interest regularly, and after the end of say 5 years or 10 years, you're going to pay the principal amount also, but yearly you're going to make them pay the interest. So quasi equity is a type of loan where interest is paid, but repayment is having a flexible option, so it may be extended also. And debt is normally secured, means if you are not able to pay the loan, you can take any assets of the company, sell it, and get back your principal amount. So equity is not having that option, because they are the owners. They can't say, you don't give me back my money, I will take this asset. Okay, so quasi equity is where you are getting interest. Equity shareholders are not getting interest, they're getting dividend only when the company is making profit. Debt gets interest even though company is not making profit. So equity, quasi equity is taking the plus points of both. Plus points of both means, as in debt they're getting yearly interest, as in equity they are not secured and the repayment option is flexible. Okay, so the best type of quasi equity is mezzanine debt or subordinated debt. Okay, so mezzanine debt means quasi equity, which is a combination of equity and debt, the best parts of both the equity. So these are the different types of, you can say, or different ways in which venture capital is financed. So we'll do a quick recap. So we have 4 types of financing venture capital. First thing is equity. So 49% of the total funds can be financed by the owned capital. So owned capital here, the best point is they don't have to be paid. There is no obligation to pay them until there is sufficient amount of profits, and the profit percentage or dividend percentage increase or decreasing depending upon the amount of profit made. They are unsecured, they are not payback during the lifetime of the company. Then second is conditional loan. So conditional loan is a loan amount where you are not repaying the money of amount of loan until that company is generating revenue or sales. No interest is paid, only royalty is paid. Royalty is a percentage of profit, which depends upon, the rate of royalty depends upon how long it is taking to generate the sales, what is the frequent inflow and outflow of cash, and how much is the risk. The more the gestation period, the more the risk, the more will be the rate of royalty. More cash outflows, less cash inflows, will be again the rate of royalty be more. So on the other hand, if the gestation period or R&D period is less, rate of royalty is less, risk is less, rate will be less. Excuse me. Third one is income note. It is a hybrid security, which is taking the advantages of both conventional and conditional loan. So as in conventional loan, it is getting interest, As in conditional loan, it is getting royalty. But like loan, conventional loan, it is not paid immediately. The loan amount is not paid, starts immediately after taking the loan. That means the EMIs don't start immediately after taking the loan. But like conditional loan, the repayment of the loan will start only when the company is making sales or revenue. And compared to conventional loan, the rate of rate is less. Then the last type is quasi equity. So here it is a hybrid of equity and debt. Like equity, it is unsecured. There are flexible payment options. Like debt, they are getting timely interest. So we also call this as mezzanine debt or subordinated debt. So this is all about the different methods of financing a venture capital. So any doubts, I want you to raise it and comment, like, subscribe so that you get further notifications. So that's all for today. Have a good day. Bye.